need to look at right now as a time where you need to be prepared. Now, I don't know when the market downturn is going to come, but how could you bridge over this? Trying to go from all-time highs over to somewhere like there, maybe we get it down here, doesn't matter. Why would you take risk to make whatever you're making in your investments when you could guarantee your return by just paying your debts off? You are recycling and recapturing money that you gave away. So we're going to put our money the same place the elites put their money, the same place all the big banks put their money, and the same place the wealthiest families throughout history have put their money. Welcome everybody, another week, another wealth webinar. This is going to be an epic wealth webinar because it's the wealth webinar right before we go into the Money School Essentials 3-day training starting Friday, ending Sunday. But I thought in the theme of today's wealth webinar, what I would talk about is what we just saw in the news today. And I'm just going to share this. We talked about this earlier today in WTF. And if any of you don't know what WTF is, it's a show we do every Wednesday morning where we literally just rant and rave about what's in the news, what's in the economy, what's happening. And we argue a lot and I cuss a lot. But anyway, forget about the cuss part. We fill swear jars all the time. They all go to good causes like, happy hour. But with that being said, one of the things that happened I want to share here is in the news just this morning, hopefully I get the right screen this time, was this. Yahoo Finance, a hard landing recession is guaranteed. So folks, you hear us talk about guaranteed a lot, but you always hear us talk about guaranteed as it relates to the infinite banking concept, as it relates to private banking systems and being your own bank. That's guaranteed because the product, the vehicle, the machine we use is especially designed and engineered whole life, which is guaranteed. Now, here you have Morgan Stanley's chief economist saying a guaranteed recession is going to happen, a hard landing recession. So a lot of you have heard us talk a little bit about soft landings, hard landings. We mention this all the time. Like, is the Fed going to pull off a soft landing? It's all over the news. And if you watch the regular news and you're not looking through the articles, that's all you ever hear. Everything's perfect, right? This administration's got us right on the right track. The lowest unemployment numbers in history or whatever they're saying. We've got a robust economy. The markets are up. Everything's good. But when you peel the onion just one time, and you don't even need to peel the whole onion, just kind of one little piece, you start to see the truth. And right there, Morgan Stanley, one of the largest banks out there, their chief economist is saying a hard landing recession is guaranteed because the full impact of the Fed's rate hikes have yet to hit the economy. We've talked about this a lot. We definitely hit it in some of the 3 days from the past because all you need to know is every time we do one of these Money School Essential 3 days, the content's totally different. There might be a few speakers that overlap, but the content is different every time because you know why? Things change. The economy changes, the markets change, cash changes sometimes, but he's always fashionably late. And if you guys don't know, because you're brand new, this little furry monster that you just saw come through, him right here, that's Lazy Cash. He's our shop cat. Yep, he is always fashionably late by design. I mean, why be early when you can be late, right? That's his motto. But going into that, I think the Fed thinks the same way Lazy Cash does, fashionably late. So when they're talking about the impact of the Fed's rate hikes hitting the economy, it's going to be fashionably late, which is interesting because it gets people thinking that everything's okay. The longer the markets stay up, the more you hear in the news, we're hitting all-time highs and all this stuff where the markets are going all-time highs and everything's good, record unemployment rates. You start to kind of build this feeling inside, this FOMO, like you're missing out. Like, I got to get back in. Oh my God, that Chris Naugle guy, that Stephen Nagy guy is telling us, we need to get out of the markets. We need to take our gains off. But yet everything I'm hearing, the markets are going up, up, and up. It's going to the moon. Yeah. Yep, that's what you're going to keep hearing because it's good publicity for the news stations. It's good narrative. It provides a good feeling. And in an election year, I don't really need to tell you what that means. It just means, hey, the administration that's rerunning is doing fantastic. No problems at the border, no layoffs going on, future, leading indicators like truck drivers. Hey, folks, Do we got any truck drivers on here? In the chat, if you're a truck driver, just put truck. I just want to see how many truck drivers we have. We love our truck drivers. They feed the nation. They supply goods and services to this entire nation, and they are the ones doing the long hours. So hats off. I don't have a hat on today, but Steven's got a hat. Hat off to all truck drivers, servicemen and women, and our current and past military. Thank you all for your services. So there we go. So we got George, we got Simon. Let's see, Simon's in logistics. And then we got Felix. Now, I talked to Felix quite a bit, but I want to ask Simon and George, are things slowing down in logistics, in trucking? I guess that would be a question, because when you look at leading indicators, so what is a leading indicator? A leading indicator would be something you look at to know where the economy is headed. Not something you look at to know where the economy is now, not something you look at to know where the economy is going to be, whenever, like a lagging indicator, like 6 to 9 months. You want a leading indicator that shows directly impacts on what's going on in the economy now. So right here, let's just see if we got anyone else saying. So Felix said things are slowing down. I don't know if I got anyone else that came in, but we'll have them come in. So when you think of leading indicators, that would be future outlooks. When companies report earnings, which they've had a lot of companies reporting earnings. How many of you saw the news recently about NVIDIA blowing out their numbers, right? Blowing it out, right? Is NVIDIA a leading indicator? Is that a good company to look at for where the economy is going? When really a lot of their profits are on chips and also AI, which is incredibly speculative and definitely manipulated right now. So no. But when you look at a box manufacturer, when you look at a trucking company, when you look at UPS and all their layoffs, that gives you a really good indication on where we are, because it's a leading indicator. It's the first thing you want to look at. Lagging indicators like real estate and hospitality and hotels and restaurants, that's not what you want to look at, because it gives you a false sense of where we're at. Because, hey, I can tell you where we're at. When we go out to eat, me and my wife, and when Steven goes out to eat, it looks like everything's bustling, right? Restaurants are full. People are having a good time. They're all driving fancy cars. Steven, doesn't it? Doesn't it always look like things are so good right now?
Oh, yeah.
And you know why? Steven, I don't know if you have that chart showing credit card debts, but people are living on credit. Not only people, but the government, the Fed. The government is certainly living on debt issued by the Fed, the Treasury. So the Fed has the total ability to control monetary policy, which is the ability for them to choose how much money gets printed by the Treasury. Treasury prints the money, and then that money is exchanged to the US government, to China, to Japan, all sorts of governments in exchange for debt called bonds, IOUs, or Treasury bonds. So right here, let's go back to the credit card, Stephen. What do we got here? Average credit card balance.
Yeah, just saying that the average credit card balance jumps 10% to a record 6360 here this month. The total credit card debt has reached $1.13 trillion this last quarter, and goes on to kind of just show this chart. What's this look like kind of since before the pandemic, we were starting to have some things kind of show like we're slowing, and then obviously the pandemic hit and all the money and everything happened, and now we've just been printing it. So kind of seeing that debt really pop. And it's according to TransUnion, it's the highest it's been. The 90-day past due has reached the highest since 2009.
Wait, since 2009. Hold on. I'm old enough to remember that. 2008 was the Great Recession. So 2009 would be when a lot of the impact of the Great Recession hit, when people lost their jobs, unemployment shot up, and defaults right now are higher than they were in 2009. I don't know where my little dinger is, but let's just see if I can find a sound effect that hits that. Yeah, that should just be a light bulb going off in your mind saying, wait a second here. And if you look at what Simon said, so we asked the question if any of the truck drivers or any of the shipping folks that are on here, the people that ship goods and services, Simon came on and he said, no, absolutely not. I'm a medical courier, and they were busiest during COVID, which would make sense. So that might be kind of like a niche field. But if you just look at UPS, not long ago, UPS did a huge layoff of their executives. And you've seen box manufacturers have massive slowdowns, and not just slowdowns, their expectations, their future outlooks are piss poor. And all companies are really slowing things down in the future. Maybe not NVIDIA, maybe not Apple, but most companies are saying the future outlook is slower because they know that. But right now, things might look great because we're still dealing with the after effects, the hangover of the crazy money printing, $5.2 trillion just during the pandemic. So this all puts together, right? You put all this stuff together. So what are we talking about today? Well, today, I want to show you, just like that video I was playing, how to opt out of the recession. I want to show you some things you can do that are completely against the masses. Okay, so what we're going to show you is going to be totally different than what your financial advisor is probably telling you, unless you got yourself a really good one. It's probably very different than what the media is telling you to do. It's very different than what your friends and family are telling you. It's very different than what just about everybody is telling you, which should tell you you're onto something. If you're doing the opposite of what the masses are doing, that's probably a good sign. Because when you look at statistics, let's just use Social Security, right? We all know what Social Security is. Someday, when you retire, you get to collect your checks from Social Security. For some of you that are younger, who knows when that'll be, but I think it's 62 you can start, but the max is like at 60, well, it's 70 is the max, but 67 is when most people start taking it because you get more, but you can't live on Social Security, right? So let's just look at statistics from Social Security, and I'll just give them to you. Social Security says that out of 100 people who are retiring, out of 100, only 5 of them will be financially secure. Out of the 5, only 1 will be wealthy. So out of 100 people, only 5% are going to be financially secure into retirement. So what should that tell you when we're thinking about where we take information? Should we take information from the 95%, the masses, the path most followed, the feel-good FOMO security path? Or should we really look at the path least followed, the 5%, and should we start then saying, where do the elites, where are the wealthy, where are the 5% putting their money? How are they handling their money? What are they doing with money? Because I would say that would be a start in the right direction. But so many people just follow what everybody else tells them. It's called conformity. And according to a study done on the strangest secret in the world by a doctor, conformity is the #1 reason why people fail. What is the reason why people succeed? Creation. What do the 5% do? Create their own path, create their own businesses, create their own solutions, create their own, create the solution to the problem of the 95%. I think that's the best thing, right? You want to be successful, solve a problem. That's it, solve a problem. You want to be really successful? Find a way to create a solution to the problem for the 95%. So as I keep telling you this, I'm just giving you these little snidbits. So what we're going to talk about today are just a few strategies, just a few, because we've only got a little bit of time with you today, that are really going to help you prepare for what JP Morgan and, we'll just say Morgan Stanley's chief economist says, which is a hard landing recession is guaranteed. So let's take that and let's prepare for that. So to prepare for that, there's a couple things that I think are really important to talk about. One of them being risk. Okay, risk is a double-edged sword. Some people say the only way to get ahead is to take risks. Wait, Chris, if we put our money into these things that you're going to tell us about, one of those being treasury bonds and T-bills, if we did that, well, we would have never made a lot of money over a long period of time. If we put money in the S&P 500, if I look in the past, we would have made way more money because there's all sorts of charts that show that. And your financial advisor will very quickly pull one of those out and be like, look at this. This is how much money $10,000 grows to over a period of time. And if you just had that money in cash or had that money in money markets or had that money in those stupid whole life policies, this is all you'd have. Look at how much you'd have in the index. But there's some very key things that are left out of that statement. And I do want to hit on one of those things. And one of those things that's left out is they never seem to tell you that the strategies I'm going to teach you are bridge strategies. Okay, not the infinite banking concept. That's a forever strategy. That's a banking strategy. But the strategies I'm going to give you today to opt out of the recession, they're a bridge, a short bridge. Okay, a bridge that just gets you over the raging river 100 feet down the ravine. I just want you to have the easiest path over this giant ravine so you don't have to walk down the cliff, go across the raging river, fight the alligators, the piranhas, maybe a shark or two, and then climb back up the other side of the ravine. That doesn't sound very fun. Some of you adventure seekers, you would love to do that. Great. Well, those adventure seekers are typically the ones that can handle the risk. But I'll bet a lot of you don't want to take that risk. You sort of want the cleanest path, the easiest path, the path that you don't wake up in one of the mornings after the market crash and look at your 401k statement, your brokerage statement, look at your investments and say, holy shit, what just happened? Wouldn't it just be better to wake up and be like, wow, look what just happened. Holy crap, what should I buy? Like, this is opportunities everywhere. I could buy anything and I'm going to be buying low. That would probably be where you'd want to be. So first thing that you have to understand is what I'm going to teach you. These are bridge strategies. Okay. The second thing I'm going to teach you, okay, which is not the bridge strategy, is the drawdown effect. Most advisors never seem to talk about this. They don't talk about one of the most powerful things in investing, and that thing is the whole idea of human emotions. Everybody understand human emotions? Pretty powerful thing. Human emotions absolutely are one of the most powerful things in the markets. And human emotions are one of the biggest overlooked things. So when I talk about human emotions, what do I mean? Well, I got a chart over here and I want to just kind of show this to you. So human emotions are when the markets go up, people get really excited. Like, for example, right now, Bitcoin just hit 60. Where's Bitcoin now? Does anyone know? Bitcoin just hit over 60,000. Where's Bitcoin?
Man. Moon.
Going to the moon. What's it at?
Just back underneath 59,844 right now.
Oh, it's down. Okay. Well, anyway, it got up over 60,000 today. So what is the news? Everywhere in the news, including Yahoo Finance, everywhere, very first thing that comes up in the news is Bitcoin. Oh my God, it's making new highs. It's, which gives people that FOMO, that sense of FOMO where they're thinking, oh my God, I got to get into this. I'm missing out. But it's a trap. When it's that high, that's exactly what you don't want to do. You want to move away from it. Okay? If it goes higher, don't worry about it. You just want to be very careful. So the drawdown effect is human emotion. So why is it that when a market starts to fall, we could use 2008, we could use the pandemic. Think back to that. I want all of you to just remember back a couple of years ago when the pandemic hit and the stock market was falling, it was free falling, right? It was like down 10, then down 20, then down 30. How did you feel? Put it in the chat. How did you feel? Scared, right? You were really nervous. Some of you started thinking, oh my God, I can't lose anymore. You start having these doomsday thoughts, which we all did, okay? Everything was falling apart. We didn't know how low it was going to go. Could it bottom out? Could it go to zero? But you know what? That was the pandemic. Let's go back to 2008, the Great Recession. We were all thinking the same thing. I was an advisor during that time. And I remember when that was all falling down, people were literally calling us, emailing us, texting us, saying, get me out. I can't lose anymore. Doomsday, human emotion. So now, remember your advisor showed you a 20 or 30-year chart of 10,000 growing to like $1 million, whatever they showed you. And in there were a bunch of ups and downs. But to get to that level, it's always easy looking in hindsight, but to get to that big number on the other end of that chart that you're shown, what that means, you got to stay in the market, which means human emotion can't play into that, which means when the markets drop 20, 30, 40, maybe even 50%, you'd have to just close your eyes. Could you do that? Honestly. How many of you on here, 153 people, how many of you could just close your eyes? If your 401k tomorrow dropped 40%, how many of you would just pick, paper loss, no big deal. I got time, no big deal. Yeah, it'll come back. My advisor said it'll come back. How many of you, right? Colleen's like, I'm good. No, not me. Emil said, not me. My money's in real estate. So yeah, Colleen's like, I'm good. That's why she's not in the markets. But I mean, listen, most of you on here would say no way. So how can you ever get to the end, right? The pot of gold at the end of the rainbow, which is the chart you're shown by your advisor for staying in the market, when human emotion flows in and you get scared. And when you get scared and you start thinking about, oh my God, how am I going to make my mortgage payment? Oh my God, I just lost my job. Like so many of those UPS drivers or so many of the other companies that have been doing massive layoffs. People just lose their jobs and like, oh my God, what am I going to do? Am I going to just keep plowing money in my 401k? Oh no, I lost my job. I can't put money in the 401k. Shoot. Okay. Well, I don't have a job, but my wife has a job. You know, she comes home and says, Chris, I got bad news. I got laid off today. And then I would say, and folks, some of you will understand what I mean by this. And then I would say to my wife, I would say, wait, Larissa, you got laid off or they just told you that You're just going to have 0 hours and you're still employed. You're going to have 0 hours, 0 paycheck, no benefits, but you didn't get laid off. You just have 0 hours. Me and Steve had covered that on what the F, and that's real. But yeah, you get laid off. How are you feeling then? I lost my job, and my wife comes home and says, I lost my job, or I'm getting 0 hours. They said I'm still employed, so I can't go for unemployment, but I'm getting 0 hours to some unknown time. You're not feeling good, right? You're feeling like, oh, honey, listen, we cannot touch the investments. They're going to go to the moon. We just got to wait it out. Someday they're going to go to the moon. Absolutely not. More than likely, you're going to dip in. Just the pinky, just the little toe first. Then you're going to go up to your knees, and you're like, that's not so bad. And then you're going to just keep taking more out, and then you're going to start living on it. And what's that going to do to your long-term effects of your portfolio? Well, let's look at that. Beware of the drawdown effect. Now, this is from a prior 3-day training. We did a prior 3-day training teaching this, and we taught this in depth. In this prior 3-day training, I showed that if you lose 10%, you just got to make 11 back. No big deal. So when we start thinking about how much could I lose before I need to be concerned? Well, if you lose 10, not a big deal, because all you need to do is make 11 back. If you make 11 back, you got back your original principal. If you lose 20%, you got to make back 25%. So right there, I draw a line at 20%. That's the point of no return, because once you lose 30% in your portfolio, you got to make 43 back. Now, I just want to make sure everybody heard me correctly. Your portfolio's down 30%. You're probably freaking out. Maybe you're employed, maybe you're not. Maybe you're just told you're going to get 0 hours, but you're freaking out. You look at you get your 401k statement comes, your brokerage statement comes, and you look at it and you're down 30%. Okay? How much do you have to make back to get back that 30% you just lost? Most people would think 30%. I lost 30, so I got to make 30 back. Wrong. You lost 30, which means your portfolio is 30% lower, which means your portfolio has less money, which means it has to work harder, called the drawdown effect. 30% means you got to make 43 back. When you lose 40%, you got to make 67% back. And when you lose 50%, you have to make 100% back. Some of you are old enough to remember 2008. 2009 came, 2010, 2011. There was a point where your portfolio got decimated, 40, 50% for some people. And then in the news, it was this magical day. The markets have exceeded the old highs. So in other words, right before the Great Recession hit, the markets are now higher than they were back during or before that terrible period of time called the Great Recession. So what would you think? You think, oh my God, thank God. Where's our statement? Honey, pull the statement up. You would think you'd have all your money back, right? Wrong. You would even be close. And a lot of people had that awakening and they didn't know what it meant. And I remember this. They couldn't understand why the markets were back, but I didn't have all my money back. I was an advisor. People were like, how come you don't have me invested in the right things? How come we didn't make all of our money back? The markets are higher than they were before. You suck as an advisor. You suck. I'm going to hire somebody else. And a lot of my clients probably did leave. I remember that. I did lose clients because they didn't think I was doing the right thing for them. They thought, oh my God, you suck as an advisor. What they failed to realize is I didn't suck. I had them invested in the right portfolio for the risk. What sucked is they failed to understand the drawdown effect. And because they failed to understand the drawdown effect, they failed to understand that no matter how good I was, most of them lost between 30 and 40%. I had to make 43 to 67% back. The market only came back 30 or 40, depending on where you're at. It didn't come back 43 or 67. Is everybody understanding what I'm explaining? Do you understand that? It's super important. Now, let me just pause for a second. I just unloaded a ton of info. This stuff isn't complicated. It's human emotion. Forget about the numbers. Forget about the percentages. It's human emotion. So please don't buy into, oh my God, Bitcoin's going to the moon. It's human emotion. It's called FOMO. Of course it feels good. It's all over the news. You're like, oh my God, I got to get in. I got to get in. Even today, and I dollar cost average in, but I always said, I'm thinking, well, should I buy some more Bitcoin? I'm like, no, I'm not going to buy more Bitcoin. What am I, crazy? Like, but you want to because you just start thinking, oh my God, I'm missing out. I got to get in. I got to get in before the getting in's not good anymore. Oh my God, if it's going to go to 140 like all the people are saying, 60 to 140, that's good. But you fail to realize like it could go 60 to 20. And that's probably more likely where it's going to go because we're now approaching all-time highs, which are around 67,000 in Bitcoin. Is it going to go higher? Maybe. Or is it going to bounce off the old highs and go lower? Well, that really just comes into an interesting game of, I don't want to say guesswork, but of really sitting there saying, what could drive the markets higher? What could drive Bitcoin higher? There's not much out there that would. It's not. The bubble has gotten so big. The manipulation through money printing was so grand that it kind of makes sense that it's taking this long for this all to unfold. But some people still want to go on the other side, and I'm sure there's some of you on here that still want to sit there and say, well, I don't know, Chris, like it's new times. I mean, you're thinking like the old way. You're thinking, just like, things are changed now. The Fed can fully control the markets. I mean, we no longer need to have these ebbs and flows in the markets. We no longer need to think like Austrian economics, like it's natural for a market to have a recessionary period because it cleanses the markets. You know what would be a really smart thing? Let me go sidebar, and I just want all of you to think about this because we're going to transition in just a second to debts. You know what would be a really good thing for the Fed to do? Take some of that crazy money they print that they just blow and go to banks and say, hey, banks, we know you've got a lot of bad debt on your books. A lot of that commercial debt from those buildings that are way underwater that are probably never going to come back. So what we want you to do is we want you to write those debts off. We want you to write the bad debts off. Now, this sounds crazy, right? We want you to get rid of all your bad debts. This is the Fed telling the banks, we want you to write off your bad debts. Get rid of them. Get them off your books. And here's what we're going to do. Number one, the write-off gives you a tax write-off, but we're going to support you. We're going to give you some money to write this off. It's not going to be dollar for dollar, but let's say you write off let's say you write off $20 billion. We're going to basically we're going to give you a bone, and we're going to give you 15 billion in tax credits, or we're going to give you 15 billion in a line of credit or something. I'm just making this all up. So now the banks are like, oh, well, hell yeah, we'll do that. They write off all the bad loans, the bad debt, which is toxic, which will eventually tank or burst the bubble. But they basically cut that off and they get rid of the bad debt. Now what they would be doing is now they'd definitely be manipulating the markets because you're essentially cleansing the markets of bad debt, which is something that you're starting to see today. Stephen showed you the chart of defaults on credit cards. Well, the same defaults are happening in car loans. The same defaults, you're not hearing about this, the same defaults are starting to mount up in corporate world. Commercial loans, as they mature, they call it the corporate debt cliff. Because all these loans that corporations, big companies took out during the low interest rate cycle are all maturing. So what happens when you go from a loan that's 2% and now it matures, but rates are now 8%? What happens? Your payment triples, right? Not a good scenario. So you're starting to see that. So all this debt, government debt, which you're probably not going to have to worry about government debt because they'll just keep printing money to make sure that that gets paid. Okay, but what other things you got to worry about? Corporate debt for sure, because corporations are what hold up the economy. And then if people's debt starts to burst and they can't pay their credit cards, they can't pay their car payments, they can't pay their student loans, well, then that means they've got less money to then spend money with all the big companies that need the money to support their doubling effect of their debt payments. You see where this all goes? Creates a really big problem. You see, that's why a market can't always go up, up, and up, and up, and up, even if the government and the Fed try to manipulate it with money printing. There's an end always. I'm not trying to be the doomsday person here, folks. I'm literally telling you the truth, contrary to what everybody else is probably telling you or what everybody else is telling the news. The feel good. I don't want you to feel good, because I know feeling good right now is a dangerous scenario. I want you to feel good, but I don't want you to feel good that things are just going to continue on like they are, because all the data shows it's not. And today, for the first time, we had a chief economist from Morgan Stanley say that it's not. So that's that. Stephen, is there any things in the chats? And folks, if you have questions about this, I'm going to get into some real tactical stuff now. If you guys have any questions, put them in the chat, or actually put them in the Q&A so we can answer them publicly. Now, I want to pause real quick because I'd be remiss not to bring this up. This weekend, I mentioned it earlier, we've got an amazing virtual event going on. It's called Money School Essentials. It's a 3-day virtual event. We've done these for years and years and years. And I bet you any money, out of 162 people, I've probably more than half, maybe even more than that. As a matter of fact, how many of you are on here for the very first time? Put I in the chat. So once these eyes come in, we'll see kind of who's on here. But I bet you a lot of you have attended one of the 3 days. And I bet you if I went through and got you all to answer honestly, you'd all say it was very much worth your time and money. okay? Worth your time and money. The time's easy because it's virtual. So you can just sit on your couch, sit in your office, be in your kitchen on your island listening. And even if you can't make this weekend, because a lot of people are like, oh, shucks, I'm going to be out on the ski hill skiing, or I'm going to be out snowboarding, or I'm going to be out on my boat if you're in Florida. You know, I can't make the 3-day. Great. Which is exactly why we record it. We don't just record it, we record it and then we edit it and we timestamp it, because not everybody wants to sit down and watch a recording and kind of be like, well, where's that part Chris was talking about where they're gonna show me how to use the infinite banking concept to further my business, and where's that other part where that guy's talking about, you know, that thing. We timestamp it all. So you literally get the recordings, the timestamps, so you literally just go right to that timestamp of what you want to watch, and boom, you get just what you need. But even if you did sit through it all, it's going to be like drinking from a fire hose. So wouldn't it be nice to be able to go back and be like, yeah, I watched that whole thing, but I really want to watch that one part again. We give you the ability to do that. We spend a lot of money on editing of the 3-day so that you don't have to spend a ton of time. We're always trying to save you time, but also trying to put you back in control of your money. So here's the deal. I'm just going to make a really quick offer to all of you, okay? This is always a free webinar. We never charge you to be on this webinar. When we have an awesome event like this, we like to let you know. And I always like to just stop right in the middle to let you know, hey, let's get the hard part out of the way so you don't get to the end and be like, oh, I knew all this was just because they were going to try to sell me something. So here, I'm going to try to sell you something. I want you to be at the 3-day event. Even if you can't be there this weekend, we'll give you the recordings. And I want you to be there so much that I've got something really cool I'm going to give you. First off, I'm going to give you a discount. The 3-day training is $297 for all 3 days. That's pretty much a bargain. But what if I made it $197? I just give you a discount code, which I think Steven just posted. So I'm going to give you a discount code to give you $100 off. So it's only $197 for you to come to the 3-day, or not come and get all the recordings. All right. So with that being said, we got the hard part out of the way. Okay, we got the hard part out of the way. There we go. Lucy, I got my $100 refund. Yeah, Lucy last week said, oh my God, I paid $297. I didn't get $100. I didn't even let her know. Sean already knew. So she just refunded it. So we always do what we say we're going to do. The $197, be there or be square. If someone on here out of all 158, see how we lost like 7 people now? If any of you 158 don't register, I'm going to sick my cat on you. Okay, so that's the downside. My cat is coming to get you. All right, so let's get back into this. This is fun stuff. So we went over this. So what is a tactical thing you could do to bridge over a market downturn? Now, I don't know when the market downturn is going to come, but how could you bridge over this? Because all we're trying to do, if you're looking at this, all we're really trying to do is we're trying to go from here. Well, actually, it's funny because now, right now, you are at all-time highs. So we're trying to go from all-time highs over to somewhere like there. Maybe we get it down here. Doesn't matter. We just don't want to ride this roller coaster down, right? Fair enough? Because I think all of you said that. You don't want to ride the roller coaster down. So if you don't want to ride the roller coaster down and you just want to bridge it, how do you do that? How do you opt out of the recession? Well, it's actually quite simple. There's several things you could do. And I'm going to hit this really quick, and we're going to hit this really heavy on the 3-day. But I just want you to understand a couple things. And I want to be clear and transparent about something. Everything I'm telling you right now is not financial advice. Matter of fact, I probably should put my little disclaimer up. So if you give me 1 second, I'm gonna just put my disclaimer up, because the attorneys have now told me I have to put this up every single time. So here you go. There's our disclaimer. Any opinion expressed by me or my castmates is solely our individual opinion, not investment or personal financial advice. This content is for informational purposes only, and this information should not be relied on for investment or other financial decisions. Nothing contained herein is financial, legal, or tax advice. Chris Naugle, any castmates, or PMC, or its members, employees, contractors may receive compensation for advertisements or marketing of third-party products and services, like the 3-day money school. Okay, inclusion of such advertising. Anyway, you get the drift. So basically, sometimes we have people on and we get paid an affiliate commission. Here, we're basically selling you a ticket, but that is my disclaimer. So now let's get into the good stuff. So now that you've got the disclaimer and you know that I'm not giving you financial advice, so let me just tell you what I did. And what I did is I don't want to ride the roller coaster down anymore. So this was first step. So any of you that have a 401k, 403b, 457, TSP, FSF, oh my God, I'm screwing it up. the Canadian version of the 401k. Yeah, anyway, we'll get in. I forgot the name of that. But, or you've got an IRA or a financial advisor, call your advisor, get on the phone with one of the people over at the 401k and tell them, hey, is there treasury bonds in the 401k offering? Call your financial advisor. Hey, how much in treasury bonds do we have? And they might say, we don't have any. Why do you ask? Well, because I'd like to add a position of treasury bonds. And for each of you, it will be different. Some of you are more riskier than others. Others don't want to lose any money. So the more safety you're looking for, the higher the percentage in treasury bonds. And it doesn't have to be one. It can be a whole, basically, portfolio of them, or you can buy an ETF like I did. I bought TLT and ZROS. Okay, those are the two tickers that I own in my portfolio. Both of them are long-term treasuries. And why would I buy treasury bonds? Well, it actually is super easy to understand, and it makes a ton of sense. Treasury bonds pay a really good interest rate. So first off, why is it that your savings account, your money market, your high yield savings are paying you 4 to 5%? Well, it's because the banks went out and did what I'm telling you to do. They bought T-bills that paid more than they're paying you. And the bank did what? Made a spread. So if the bank pays you 5% in your high yield savings, but they're making 5.6 on T-bills, who's winning? Both of you. But who's winning more? The bank. They're making a spread of 60 bips, 60 basis points. So they pay a good interest rate. That's first reason. Second reason, they're one of the most liquid investments you can put your money into. In other words, if you buy a treasury bond or a treasury bill and you want to sell it tomorrow, there's a bunch of people waiting to buy it at any price. Okay, so there's total liquidity of them. But here's the real reason. It's called the inverse relationship. Okay, so what do I mean by that? Well, if we look at price and we look at interest rates, they're inverted. So let me explain that. Draw an X. Okay, I got an X here. The price of bonds goes down when interest rates go up. When I had my Series 7 in the exam, and Stephen had this too, this is how we learned it. It was a little pendulum. Remember that little thing? It looked like a seesaw. Remember, interest rates go up, bond price goes down, and the opposite. That's how we learned it, but I like doing the X. So over the last couple of years, the Fed has done what with interest rates? Raised them, right? I know this year they said they're going to lower them, but up till this point, they raised them very fast. From close to zero up to 5.2 to 5.5%. That's a big jump. Hence why a lot of banks went out of business or insolvent, but we won't go there. And the reason the banks went insolvent, actually I will go there, is because the price of the bonds when the interest rates went up went way down. So if a bank owned a bunch of bonds at the high price up here that they bought prior to the Fed raising rates, now all of a sudden the bonds are really low. And when you and all your buddies and friends rushes into the bank and wants their money back, they got to sell the bonds at a lower price. Game over. Hence Silicon Valley Bank and all those others. So, but for you, this is a pretty unique opportunity because you can buy them really cheap. Why? Because interest rates just got raised so much. So rates went up, the price of bonds went way down. Stephen, can you pull up, I don't know, pull up TLT and just show people how far down the price of bonds went. So TLT is the ETF, exchange traded fund that I own in my portfolio. Not making a recommendation, it's just what I own, and I'm happy to prove it and show you. TLT owns 20+ year treasury bonds. Keyword 20+ year. We got to do long duration, but that doesn't mean you need to own them for 20 years. It just means they're long duration. So when we look at this chart here, this is a 20+ year treasury bond or an ETF of treasury bonds. So if you remember in 2020, that's about when the Fed started raising interest rates. And look at what happened, 2020 to 2022, price came down. 2022 to 2024 through 2023, the price came way down. We went from 160s down to, where are we at today? What's the price? 93 bucks, 160 to 93. And actually, if we were to do, Stephen, do all real quick. Just punch the all. I just want to show people. We are pretty close to the all-time lows as far as this chart will show. So there's 2000, that was after the dot-com crash. Look at, that's where we're sitting price-wise. You can buy treasury bonds at the same price today that you were able to buy them pretty close to back after the dot-com crash. Some of you weren't even alive, or some of you were just babies at that time. So all I'm trying to say is now is a really good time to buy treasury bonds because they're freaking cheap. They're cheap. But what's the other reason to do that? The other reason to do that is the other side of the coin. What did the Fed say they were going to do this year? Well, Jerome Powell kind of opened the front door for 3 rate decreases. Then Wall Street came in and said, oh, you're going to go 3 rate decreases? We think you're going to do 6. And they built in 6. So they think that the market, they're going to bring interest rates down in 2024. I would guarantee, just like Morgan Stanley did, that they will bring interest rates down because we will end up in a recession. And that, what do they do when we go into a recession? They drop interest rates. So we're up around 5.2 to 5.5, and they're going to drop interest rates. So what happens when interest rates go down to the price of the bonds that you bought really cheap? Well, the opposite. The price goes up. When interest rates go down, the price of the bonds go up. Everybody understands that, right? Buy low, sell high, which we haven't talked about the sell yet. Don't lose money. We all understand that's the best strategy to make money. And if you don't believe it, well, Warren Buffett said it, so he's smarter than I am. Buy low, sell high, and don't lose money. So what is the strategy here? Pick the phone up, call your advisor, have a discussion about your risks and how you don't want to lose money and you don't want to ride the markets down. You know, you don't like what you're seeing. I'd like you to look into some treasury bonds for me. By the way, could you look at these couple ETFs if that would be easier? And I would like you to buy them and shift my risky portfolio into a conservative portfolio if it's appropriate for your needs and goals, folks. I'm just talking about like how you do a call. I'm not trying to give you investment advice. Just call your advisor. And then what you're going to do is you're just going to sit back and you're just going to wait. You're going to join us for these wealth webinars. You're going to join us for what the apps. You're going to watch the news or not watch the news, but you're going to see it unfold right there in front of your face. You'll be watching your favorite show or listening to your favorite radio station, and you'll hear how the Fed dropped interest rates, and then they'll drop interest rates again. You're not even paying attention. And then you'll be like, wait a second. Chris said on that 3-day Money School Essentials virtual event, he said, when the Fed's dropping interest rates, bonds should go up. And oh crap, we bought some of those bonds. So you'll go in and you open your statement up for the first time in 6 months and you'll be like, holy crap, I made money. And you know what the best part about that little exposure, that little moment you have with yourself when you look at your statement, you're like, oh my God, I made money, is that you made money and everyone else around you probably lost money. Isn't that cool? Like you made and everybody around you lost. I'm not saying that's a good thing. Don't be beating your chest. Don't go around bragging. People will knock your ass out. But like, you'll feel good about that, right? When everybody else is losing, the 95%, you, the 5%, made money because you changed where your money went. You moved your money into this strategy. And because of that, you effectively avoided a drawdown. Okay. You didn't have to ride the roller coaster. You don't ride the bear, ride the bull. Okay. You get to ride the bull and you got to bridge over. Now, here's the cool part. When you look at that and you look at how much money you made, you just pick a time when you want to sell it. Don't hold the treasury bonds forever. Just pick a time when the profit suits your needs and you just sell. You go in and you tell your advisor, sell. You go into your 401k, you sell, and you make money. And then what do you do with the money when you make it? Well, you just put it back in the markets because now everything else is cheap. Now treasury bonds are high. You don't want to buy those anymore. You sell the ones that are high. And what are you going to do? You're going to buy the stocks that you bought before because now they're low. See how easy this is? Like I teach this all the time and sometimes I sound like a broken record with this stuff, but man, it is so freaking easy to bridge over this. And you can do this inside of any account that you invest in. 401ks, not all 401ks are going to have treasury bonds. You got to look long and hard, which is why you're going to call the 401k provider and ask them. Okay, you can do this with your brokerage accounts, with your advisor. You can do this with your TD Ameritrade, your Raymond James, your Schwab, your American Funds, your Vanguard, whatever you got. It's available to all of you. That's the beauty. And you know the best part about that is me, Steven, Shauna, my whole team, we make nothing. Nothing. Well, if you buy a ticket to the 3-day event, yeah, we make $197, but then I give it all back to you in a deck, a beanie, and a shirt, and $100 off. Yeah, anyway, we make a little bit of money. But we're not making any money by telling you how to keep your money. And all I'm really trying to do, folks, is sum up why you need to be at the 3-day to learn more about this stuff, but not just that, why you need to look at right now as a time where you need to be prepared. So that's the first step. How's everybody like that? Okay, everybody like that? Great, let's move on. You ever feel like you don't have control of your real estate business or your money? That's right, the big banks and the institutions, they're in control, right? I know you felt that before. Private Money Club puts you back in the driver's seat. As members often tell us, it's a total game changer. Join the community of like-minded lenders and borrowers by going to privatemoneyclub.com and sign up. We're gonna hit 3 things today, is that okay? We're gonna cover 3 things you can do to opt out of the recession. That's all we're going to do. And the final one I'm going to do is going to be the one that's always the favorite, is the infinite banking concept. We're going to teach you how to be your bank, your own bank, which I'm going to get into a little bit here, but I'm going to kind of brush into it. So here's the other thing that you must do. And actually, I'm going to pull up a chart because I think this will be the easiest way to show this. Remember, we talked about FOMO. We talked about following the news. Buying high is not good. All those things are bad. But you know what else is bad? Debt. And I'd be willing to bet, as much as all of you are the 5%ers, we all know that, I'd be willing to bet that a lot of you have some debt. You don't need to tell me. I just know. Why? Because statistics say that you have debt. And not all of that debt that you have is good debt. Yeah, I know. We always hear Grant Cardone talking about, oh, good debt. There's good debt. You know, good debt is the debt you have on your rentals. Good debt. Well, ask people that own giant office buildings how their debt's good for them right now. Even though it was good debt before, it's not good debt now. Debt can be good, but for the most part, debt is bad. Now, what kind of debt is the worst? Well, it's easy. How about credit card debt? How many of you think credit card debt is good debt? Anyone? Nope, bad debt. How much is credit card debt ranking? I mean, Stephen showed the number. Stephen, what was that again? How many people are defaulting on their credit cards?
A lot.
A lot, more than 2009. So credit card debt's bad. And what happens to credit card debt's interest rates when the Fed raised rates? It went up. Yeah, how many of you got those like emails, or maybe you got the piece of paper that comes in the mail that you don't even look, you just tear it up because it looks like junk mail? Well, that in there is their disclosure showing you that, hey, we like you a lot. This is Amex or Discover, but we're going to raise your interest rate. Yeah, we're going to raise your interest rate from, remember that 15% you thought? Yeah, we're going to go to 29. No big deal. So maybe just 24 because you're good credit. So credit card debts are bad, and most of them right now are between 50 and 29%. You know what other debt's bad? Car loans. You know why car loans are bad? Because the car depreciates underneath you. So as you're paying for the car, you're giving away principal and interest, and those payments are high. How many of you have a car payment under $500? Put 500 in the chat. How many of you have a car payment under $500? Put 500 in the chat. We got 158 people here. I bet you there's probably maybe 10, 15 people, because cars are more expensive now. So anyone that bought a car recently, there's a good chance your car payment's over $700, because that's the average. The average car payment's over $700. So this is a really smart group right here. I'm loving this. You know, we got some 2017 Camrys at $335. We got a bunch of people that have less than 500, 324. That's awesome. It means you guys are really smart with your money. But I already knew that. Me and Steven already knew that. We talked about it before. Like, the person's got an Avalon for $396. Avalon's a beautiful car. And you know why you're smart? Because you're the 5%. You're not following the herd. You're not following all the other folks, you know, off the cliff and going out there and raking up big car loans. But still, even if your car payment's under $500, do you like making it? Do you like making your car payment? Anyone? Do any of you, I don't care where you're at, do you like making your car payment? No. Do you know why you don't like making it? Because your car payment is a payment that goes to someone else. That money leaves your family every single month. And out in your garage or in your driveway is that car. And that car every single day is worth less money. We know this to be true. And that car out in the driveway costs us money, because to keep it on the road, we got to register it, inspect it, put new tires on it, new brakes. Something's always going bad. I was in a Camry today with Brandon here at the office, and I heard a hum. I'm like, you got a bad wheel bearing. He's like, oh man, really? I'm like, they're not expensive to fix. It's just that you hear that hum. He's like, no, I don't. I'm like, it's a wheel bearing, no big deal. I mean, he's like, yeah, I got 140,000 miles on it. Like, I can't believe the wheel bearing's gone. I'm like, oh my God, you know, 140,000 miles on the car, your wheel bearing's gone, and you're complaining? But hey, listen, things break. So cars cost us money. That's why you don't like making the car payment. How many of you have a monthly payment for your cell phone? How many of you financed your cell phone? Put I in the chat. Almost all of us, right? I don't. I pay cash for it, but I bet you a lot of people finance their cell phone. I bet you a lot of you that have a cell phone don't even know you finance it. It's just in your phone bill. You just pay it, okay? So all of these debts require you to make a payment to someone else's bank, which requires you to have money leave your family forever. And in return, depending on what it is that you're paying for, you've got something that's depreciating in value. Fair enough, okay? So, you know the best way to completely go under during a recession? What's the number one reason people fail financially during a recession? Can anyone tell me? Debt. 100% of the time. It's the number one reason people fail. It's not because they can't support their debt. Okay, because right now most people are supporting their debt because most people are employed. But when they're not employed, when they get laid off, when there's downsizing, when there's job cuts, when we enter a recession and those future leading indicators become real, where actually the economy is softer and weaker than they showed you, people will lose jobs. And when people lose jobs, their income gets cut. And when their income gets cut, debt becomes a problem. Because once a luxury, now a necessity. Things that used to be luxuries to you now are the necessities in your life. Air conditioning, power windows, power seats, you know, the things in your house that you bought, the luxuries that you once thought about that now are just fixtures in your house. All those things are now necessities. But those necessities were purchased largely by debt. So you want to fail during a recession, carry debt into a recession. So you want to turn your debts into wealth for yourself? You want your debts to be wealth? I'm sure all of you do, right? The fastest, listen to me closely, and if any of you are writing this down, and Sean or Stephen, if you can put this in the chat, because I want people to write this down. This is very important. The fastest way to build wealth is through your debts and expenses. Let me put that again. The fastest way to build wealth is through your debts and expenses. Let me prove it. Because some of you are like, I have no idea what this idiot is talking about. I have no clue how my debts and expenses are my fastest way to wealth. I think he has completely lost it, or maybe he's drunk. I haven't had anything to drink today. Although I wouldn't mind having an old fashioned right now, but I haven't. So let's talk about why debts and expenses are your fastest way to build wealth. I already described how every one of these debts that you have is money leaving your family forever. Now, credit cards come with a cost of 15 to 29%. Car loans, how much is everybody paying for their car loan? Can we just have some people put some numbers in the chat? What's your car loan costing you? Car or truck loan? I got some folks on here who love trucks, and I love trucks. 3.2. No, not dollar amount, percentage. 4.5, 4.5, 5%. Okay, so as they come in, let's just say 4% is the barometer. So let's just say on average, your car loans are costing you 4%. Let's say on average, your credit cards are costing you 18%. Everybody's got that? Now, 4% seems like a pretty good interest rate, right? And by today's standards, it's really good because you couldn't get a car loan right now under 7%. So if you got a 4 or 3%, that's pretty freaking good. So a lot of you wouldn't pay your car loan off because you'd be like, well, why would I pay it off? It's only 4%. But when you look at it and your car payment at that 4% car loan is $475 a month, okay? What I want you to think about, and I want you to think really long and hard about this, 4%. That's what you're paying for your car. And some of you are less, some of you are more. Just remember that, 4%. How much is your bank account paying you right now? Put it in the chat. How much is your bank account paying you right now? 0? Mine too, man. Martin, you're not alone. 0.99, 0. Pretty close to zip. 0, 1. Not sure. Nothing. I mean, there's a couple people on here who have high yield savings accounts. Anyone got a high yield savings account? I bet you your high yield savings account just paid you less than it did the month ago. 4.5, okay, pretty good. Nothing worth mentioning, a percent. So now your car loan is costing you 4%. You're pretty proud of that because it's cheap by today's standards. But your bank account, where your money is paying you 2% or less. See what I'm trying to say? You're giving away 4, you're making 2% or less in your bank account. Now, let me really spice this up. You're giving away 4% to the car loan, okay, when that 4% could be making you 12% in Private Money Club. Anyway, not important. So 4%, don't let the number fool you. I don't care if it's 2 or 3 or 4. If you're not making that in your bank account on guaranteed money, you're losing. So all your debts are probably more than 4%. Your cell phone loan is probably 0, but why is it 0? Because you're giving a monthly check. You're giving them money every month. You could take that money back. Every loan you have. So let's just assume that you're giving away all your debts. Let's average it out with your credit cards. Let's just say your average amount, and I do this all the time, is 13%. And how do you figure that out? Go through all your debts. Every credit card, your car loan, throw your mortgage in there too. You probably got a cheap mortgage. HELOCs, all those things. I want you to add them all up. Let's just say there's 10 debts that you have that you add up. Add the interest rate up. So let's say it's like 100. Divide it by 10, it's 10%. So your average is just taking all your debts percentages and divide it by the number of total debts. That gives your average. I bet you most of you would come out with something like 13. Some of you would be quite surprised at the number being higher than 13, but let's just say it's 13%. You're on a monthly basis. Now remember, all we did is an average, but remember in your 401k, when they show you the return, what is it? When they show you all these fancy mutual funds, these retirement date 2045s, it's an average. Oh, over 10 years, this fund's averaged this. Over 5 years, it's averaged that. So we're doing the same thing. We're just copying, okay? So your average amount you're giving away is 13%. Now, how many of you made 13% on your investments consistently every single year for the past 5 years? Put I in the chat. 13% every single year without missing a beat. You never, ever miss a beat. You make 13% or more every single year for the last 5 years. Rick said no one, but I'm sure, Nancy Pelosi probably did. She's the best stock picker in the world. No one, right? Rick said no one. I want you all to just stop and think about that. Your investments, which you're taking risk to invest money into, which you are going out on the limb wondering, oh my God, I hope it's going to keep going up. It's going to go to the moon. You're taking risk. When your guaranteed return, which is your debts that you're paying every single month, you're giving away about 13% average or more, as some people said. Why would you take risk to make whatever you're making in your investments when you could guarantee your return by just paying your debts off? Take the amount you're paying to your 401k, pay your debts off. Take the amount you're giving your broker every single month, pay your debts off. And I'm going to show you in just a second, there's a way better way to do that where you can make your money work twice by just changing where it goes. But I'm just trying to keep this simple. So here's how it would work. Let's just say, let's forget about the policy. Let's just say this is your bank account over here, okay? Someone else's bank. You've been putting your money in someone else's bank, which I know a lot of you are already past this. But let's just say your bank account's paying you a whopping 4%. Most of you are not getting that, but it is. So what we're going to do is we're going to change all of our investment savings on a monthly basis. We're going to put it all here. And then some of you are going to go in and you're going to sell some of your investments because they're too risky and you want to get out while the getting's good, which right now the getting's real freaking good. You're at an all-time high. You want to get out at the top, so you get out and maybe you got some extra money coming in. So you got monthly savings that you were putting in 401ks, IRAs, whatever. And you take all that and you put it over here into your bank account. So forget about this. Just goes into your bank account. Plus, you got some lump sums from you sell some things and take some gains. You put that there. Now what we're going to do is we're just going to take that money from that bank account. And we're going to come over here and we're going to organize all your debts from lowest balance to highest. Everybody got that? Lowest balance to highest. Now, this is not always the best way, but I'm just keeping things simple here because the 3-day, we're going to go deep into this. And we're going to show you that it's a mathematical calculation, which most of you wouldn't be able to do. It takes complicated calculators to be able to figure out the best way to pay off debt. But you know what? We know how to do it. So if you join us for the 3-day, we'll show you how to do it, or book a call with one of us. We'll show you how to do it. But listen, I'm just trying to keep this simple. Lowest balance to highest. Forget about the interest rate. Everybody wants to pay the highest interest rate off first. That is not the way to do it. It's lowest balance to highest, just as a starting place. So now what we're going to do is we're going to take the money in our bank. We're going to leave at least 3 to 6 months in there, or what I would suggest, take 3 to 6 months of your savings and put it into a separate bank account. Take that money and put it into a segregated bank account. This is called your emergency fund. So now we've got, let's just say 10K sitting over here, and you're not going to touch that. That's for an emergency. And then what we're going to do is we're going to take whatever other money is in our savings, and we're going to come over here and we're going to start paying debts off lowest to balance. And every time we pay a debt off, key thing to understand. Folks, what you guys don't even know, I'm teaching you the infinite banking concepts. Did anyone pick up on that? Stephen, you knew that. Shauna knew that. Do you realize what I'm showing you right now is a process called the infinite banking concept? How many of you knew that? Put yes in the chat. How many of you knew what I'm showing you right now is the infinite banking concept? Because a lot of you would be like, wait, Chris, no. It's not the infinite banking concept. The infinite banking concept, you need a whole life. No, you don't. You can use a bank account. I'm showing you using a traditional bank account. It doesn't matter. The infinite banking concept is a process of taking back the banking functions in your life. A process, not a product, not a whole life policy, not a specially designed whole life, never an IUL. It is a process. And that process can be done from a 401k by using loans. It could be done from a HELOC by using loans, but I don't like using HELOCs on it. It could be done using a bank account, a money market account, a brokerage account, whatever, as long as the money starts in a place with a guarantee. That's all, okay? Process of taking back the banking functions. What are the banking functions that you're giving away today? Well, we already talked about it. You're making a car payment every single month to somebody else's bank, giving the banking functions away. You're making a payment on your cell phone every single month, giving your banking functions away. You're making payments on credit cards every single month, giving your banking functions away. You're making payments on lines of credit, on term loans, for everything else, giving your banking functions away. I'm just showing you how to take it back right here and right now. You take money from your bank, future savings that you save in your bank. You move it over here. You pay the debts off, lowest the balance. And every time you pay a balance off, let's say the first thing we pay off is the cell phone. And remember, the cell phone was 0% interest. But why did we pay the cell phone off? Let's just say it was only a $1,000 balance. It's the lowest balance. And every single month, you made a payment of $80 a month, whatever it is. You owed $1,000 on the cell phone, but you're making an $80 payment. So now, what we're going to do, cell phone's paid off. We no longer have to pay Verizon, AT&T, Samsung, or whoever you got to finance $80 a month. So what are we going to do with the $80? Well, duh, we're going to take back the banking functions. You're going to literally do a transfer from whatever account you paid the bill from, and you're going to transfer that money back over into the same bank account. So now you got $80 more added to your savings that you didn't have to work any harder for. You didn't have to take on any risk for. And you didn't have to do any overtime for it. It was money you were just giving away because you were giving away the banking functions. So now that we did that, now we've got the savings that you were doing. Let's just say that that's $1,000 a month. Okay, so you were saving $1,000 a month, but now we're saving $1,080. You're saving $1,080 because you were giving $80 away to the cell phone company. So let's go faster now. Everybody understands what we're doing. We're literally drawing a circle. All I want you to think of is this is just one giant circle. All we're doing is we're just connecting where the money comes from with where the money goes every time. So cell phone's paid off. Next, we go through, we pay off a credit card. We add $100 a month once that credit card's off. Then another credit card, $200 a month. Then the car payment, $475 a month. Catch the drift on what I'm doing? Every time we pay off a debt from our savings and from our recaptured money, we're basically just adding more to the recaptured amount. You are recycling and recapturing money that you gave away. So pretty soon, over a period of time, you're no longer giving any money away. All the debts are paid off. But you know what the debts now are? The debts are now assets to you. The debts are now income to you because it's money you gave away before, and it's no longer money you have to give away because now all that money, every monthly payment, is going back to you in your bank. You just completed the infinite banking concept. And how much did you make on that money? In that example I gave, and each of your examples are going to be different, 13%. How much risk did you take to make 13%? Zero. How much energy did you have to put out there at your job or in your business to make that 13%? Zero. What did you have to change? Just your mindset. Just how you do what you already do. And then what was the downside of this? Well, it took some time. It took a little bit of time. So everybody understands that, right? Now, let's throw a monkey wrench in this. Everybody understands everything I just said, correct? Does anyone not understand this? Please, like this would be speak or forever hold your peace, I think is how they say that. Anyone not understand what we just did? Very important as we move on. We're going to go deeper into this in the 3-day. We're going to go deeper into the economic things. I've got notes upon notes upon notes of what I'm going to teach you. I'm going to teach you all about how to build this bridge. I'm just giving you high-level stuff. Okay, everybody's got this. Or everybody's just being really quiet. Real quick, Stephen, can you put the link up for the 3-day Money School Essentials? Everybody just needs to take a little breather here. So we're putting the link up again. So for people that are just coming on, we made an offer earlier for all of you to join us this weekend, Friday, Saturday, Sunday, for the Money School Essentials, the 3-day virtual event that is recorded, edited, and time-stamped. If you can't make this weekend, we offered you a ticket. They are $297, but we offered you $100 off by just putting in that little thing. We also then sweetened the deal by not just giving you $100 off, making it $197, but we offered to give you a really sweet toque or beanie, depending on what part of the country you live in. So now I told you we're going to throw a monkey wrench. Everybody understood what I just taught you, which is called the infinite banking concept, the process of taking back the banking functions in your life. But I want to make it better. All the numbers are identical. All the numbers are the same. Nothing's going to change. The process is identical, except for we're going to change one thing, folks. I know it's hard, right? We're going to change one thing. Remember all that money you were saving, the money that you used to put into the 401k that you're no longer, the money that you used to give to whoever? We're going to change where that savings goes. We're no longer going to put it in a traditional bank, because so many of you on here told me that your traditional bank pays you nothing. Some of you said it pays you a little bit. Some of you had 4.75. A week ago, 2 weeks ago, people were making 5.25. You see how now the highest I saw, and I might have missed one, but the highest I saw was 4.75. See what's happening, folks? Anticipation of lower rates are driving the banks to pay you less, because it's bringing treasury bill yields down. Everybody got super excited when their bank account, their high yield bank account, paid them 5 or 5.5%. They were like, oh my God, this is never going to end. It just did. It didn't end, but now it's less. And when the Fed continues their ramp it down with interest rates, it's going to get worse and worse. And pretty soon, all of you, when I ask the next time, you're all going to be like, I'm going to ask, how much is your bank account paying? How much is your high yield savings paying you? And you're all going to look around, you're going to be like, 0 or 1%. What happened to those days when we got 5.5% on our money? You weren't in control of the money. That's what happened. You gave up control of your money to a bank in one capacity or the other, or Wall Street in one capacity or the other. And therefore, the bank was in control to change the rate whenever they wanted. What if you're in control of that? Well, you can be. You can change one thing, and you can change where your savings goes. You can change where those lump sums, I'll just put it a lump sum dump in. You can change where those lump dumps go. Lump dump. Sounds like diarrhea. Anyway, you can change where those go. And what we're going to do is we're going to put our money the same place the elites put their money. The same place Morgan Stanley puts their money. The same place Bank of America puts their tier 1 capital. The same place all the big banks put their money. And the same place the wealthiest families throughout history have put their money. I saved the best for last, but all of you understand this, and all of you mostly know what I'm going to say. Where is the place where the elites and the banks and the wealthiest families put their money? It's not a bank. It's not a traditional bank account. It's not a high yield savings account. It's a freaking stupid whole life insurance policy. Hold on, I'm not done. From a mutually owned insurance company that pays dividends. That's what it is. But I could add one thing. It's not a normal whole life. It's a specially designed and engineered whole life. It's very different than the whole life that your sister-in-law or brother-in-law tried selling you during the holidays. Totally designed different. It's designed for high early cash value. It's designed to give you immediate liquidity of your money in the first 30 days. It's also designed with companies that support that process that I just taught you, the infinite banking concept. But the infinite banking concept works a lot better when you got more money to use right in the beginning. So why would we use a whole life insurance policy? Well, forget about what it is. Let me just tell you what it does. A whole life insurance policy contractually guarantees you an interest rate. And with one of the companies, actually several of the companies we have, that guaranteed contractual interest rate for the rest of your life is 3.25%. 3.25% for the rest of your life. Can never change. Will never change. But because, and some of you aren't too excited, you're like, well, 3.25, Chris, isn't really that good. But you know what? It's better than the sharp stick in the eye. And it's certainly better than a bank account paying you nothing or 1%, or a bank account that paid you 5 that now pays you 2, right? Okay, so we just got to compare it to the right things. Because a whole life insurance policy, contrary to some of the assholes on TikTok and Instagram, is not an investment. It is guaranteed. It's like Morgan Stanley said, guaranteed recession. It is guaranteed. So something that is guaranteed has 0 risk. Therefore, it is not an investment, because to be an investment by definition, it must have an element of risk. And whole life has no risk because it is guaranteed. So guaranteed 3.25, but that can't be all we make. No, remember I said it's a mutually owned life insurance company. And because it's mutually owned, when you become a policy holder of a mutually owned company, you're kind of like an owner. You're kind of like, you're one of the clan. You're one of the peoples that the company has to pay you out on, right? So what do they pay you? A dividend. And these companies that we work with have paid dividends every single year, never missed one. Not for 140, some 160 years, never ever missed one. Not through the Great Recession, not through the Great Depression, not through the pandemic, not through the dot-com crash, never missed one. So today, the dividend plus the interest gets you to anywhere between, I think our lowest right now is what, 5.3? Where are we at with our lowest now, Stephen?
5.35, yeah, right around that.
5.3, and our highest is 6.2, something like that. But let's just keep 5.3. Okay, we'll go with that.
Yeah, it gets complicated because of the different ways the insurance companies calculate
Right.
and close it. And so right around 5.5 is the actual rate, it seems like on average with all the companies we use.
All right, so that's the lowest of the companies we use, 5.3. Now, is anyone making 5.3% with your bank? Anyone? If you are, put 5.3, because we probably have one. Okay, nobody probably is having, yeah, nobody. So we got nobody doing that. So right out of the hole, that's better than what your bank's paying you. But hold on, this 5.3, if we design your policy and we would do it correctly, is tax-free. So how much would you have to make in a bank account or any brokerage account or any account like that after tax to make 5.3? Well, depending on your tax rate, you'd probably have to make somewhere around 7%. Anyone got a bank account paying them 7% guaranteed? No. So right off the bat, the 5.3 was higher than what the bank's paying you, but now that 5.3 is tax-free, plus that 5.3 is protected against judgments and liens. So if you get sued, somebody slips and falls on your property, you're protected in most states. Your bank account protected? Hell no, your bank account's like an apple tree that just dropped all of its apples. It's not just low-hanging fruit. The fruit's already on the frickin' ground. Just pick it up. Protected against judgments and liens, tax-free, pays a good dividend with a guaranteed interest rate. But see, that's not even enough. Because like some of you would still be like, I don't know, I don't like any of that. That's still a whole life. Dave Ramsey said those whole life policies suck. Even if it's specially designed and engineered, I'm not having it. Okay, but let's say your money's earning 5.3 and you take 90% of it out to pay off debts. So let's just say you got 30 grand that you put into the policy and you take out 20 grand to pay off debts. How much money is left in the policy earning 5.3%? Well, Chris, hold on. Let me grab my calculator. 30,000 and we took 20 out, so 10 grand, right? There's 10 grand left in the policy, right? 10, wrong, 30. You never took your money. If you started with 30,000, you never took your 30,000 out because whose money did you use? The insurance company, of course. Because not only did the insurance company guarantee you contractually a 3.25% interest rate if you use that one company, they also guaranteed you a death benefit. As long as you make it through underwriting, they guaranteed to pay a death benefit out someday when you die. So if you had 30 grand, you probably got a, let's just use a $500,000 death benefit because the death benefit is going to be a lot lower on the policies we design than the policy your sister-in-law or brother-in-law tried selling you. I promise you that. That's one promise I can give you. When we design your policy for the infinite banking concept, it will have a lower death benefit than the policy your brother-in-law wanted to sell you. Just is what it is. And the reason for that is we want you to pay less in cost of insurance fees. Okay, we don't want costs. So we put the lowest death benefit allowed by the IRS. But there's still going to be a death benefit. So when we took this $20,000 out, how is it that we still have 30 in our account? We didn't take any of our money. Well, it's because this 20,000 was a loan. The insurance company allows us to take part of our death benefit, in this case, 20 grand, from our death benefit. So now your death benefit is 480,000 after we take the loan. But now your 30,000 in your account is still earning 5.3 uninterrupted, and the 30,000 acts as collateral for the $20,000 loan. And the insurance company does charge interest, and this fluctuates a little bit, follows the bond LIBOR index. But right now, some of the companies we work with are about 5%. So you're making 5.3 gross, you're giving back 5%, but your 30's compounding, tax-free, protected against judgments and liens, plus I got myself a death benefit, and I still get the money to use to pay debts off. Yeah, but it gets even better because now you do the same thing you did before. You take the monthly payment you used to give to the debts, You take that monthly payment and you put it back in the policy as a loan repayment. So now the $20,000 loan is less every single month by whatever your recaptured amount is. So now are you paying 5% on 20 grand? No, you're paying 5% on a lower balance every month. So are you actually doing a 5% APR? No, it's lower. Every month it gets lower. It's just mathematics, folks. But every month your balance gets higher. See how this works? Your money's going up. The money you're giving away is going down. One goes up and one goes down. That is the best definition I can give you of compound interest versus simple interest. So that's the infinite banking concept. So first, I talked about how to bridge the gap. I talked about treasury bonds. Okay. I talked about how you can do that with your advisor, with your 401k, with your retirement accounts. Just call and ask. Then I showed you how you can use the infinite banking concept, how you can build wealth through your debts and expenses, the fastest way to wealth. And we use 13%. And then I just said, let's not just make 13%. Let's make 13% plus a spread, because we want to be the bank. And if you're making 5.3 and giving back 5, you are making a spread. But every year your spread goes up because you're still making compounding interest and you're paying less and less. So your spread goes up automatically because of mathematics, not because Stephen Nagy told you it does, not because Chris Naugle said it does, because of math. So folks, this is just a snapshot. This is literally just a snapshot. We're going to be doing this for 3 days. And we're going to be bringing in some of our friends. We're going to be bringing in some players. And then here's the other thing. Well, I've got 143 of you left. I'm going to just kind of lay out some of the things that we're going to be going over. The first day, me and Craig, Yenny, and Steven are going to basically present something that we've never done, just like we did last 3-day, but it's totally different. Last 3-day, we told you a risk-free return, and we used treasuries and policies in the infinite banking concept in a strategy that no one ever has pulled off. No one has ever taught what I taught last 3-day. This 3-day, we are not going to be able to say that we're teaching something that's never been taught, but what we're going to do is take something that the late R. Nelson Nash, the founder, the pioneer of the infinite banking concept, the godfather, if you will, the man that taught us all what the infinite banking concept is. We're going to take something he did in his book, Becoming Your Own Banker, and we're going to modernize it. We're going to show you modern day numbers. And we are literally going to dissect the mathematics of how this works, not so much for individuals. I just showed you how it works for individuals, but we're going to show you how it works in corporate use. So if any of you have businesses, you're going to want to be there Friday, or you're going to want to watch the recordings Friday. Then on Friday, we're going to talk a lot about how to be your own bank using your retirement accounts. How to do everything I just said, but you do it with your retirement accounts. Okay, there's some rules, but we're going to go over that. And we're going to bring Greg Hurleen on for that. And then what we're going to do is we're going to talk a little bit about what I started today in the economic environment, but how to protect yourself. But I'm going to go deep into it. Today, I just brushed the surface. I'm going to go deep into that. And then the second day is action-packed, but the third day, okay, we're going to have opportunities. All we're going to do is, now that we taught you how to take back control of your money, then we taught you how to make more money. Now we're going to show you all the opportunities and how your money can continue to work for you with a lower rate of with a lower risk and a higher rate of return and security. We're going to bring a bunch of people on that we use for our own money to make our money work. And we're going to basically open the door to you to be able to work with the same people that we're working with. And then, I don't know how to say this, but the first day, I think it is, and correct me if I'm wrong, I think it's the first day. I got one shot at this. I've got an opportunity that was brought to me 2 days ago. It's an opportunity that I was going to be selfish and just, do some of it myself and not really share it. But I made one phone call, so I'm not going to lie. I made one phone call to one of my really good clients saying, hey, if you want this, you can have this. It's a stupid good deal. But let me just give you some of the sum ups. It's pretty much risk-free. Okay, I can't say it's guaranteed, but it's pretty much risk-free. It pays 18% interest. I'll give you the bad news, maybe good news for some of you. It's probably going to be really short term. Okay, could only be a month, could only be 3 months. I don't know, but it's only going to be short term. I would say 6 months or less. Okay, that's going to be the opportunity. 18% annualized, a very short term deal. You are going to be 100% in a collateralized position with one of the best assets in the world, an asset that is guaranteed to pay out, because there's 2 certains in life. Do you know what those are? What are the 2 certains in life, Stephen?
Death and taxes.
Death and taxes. So it's guaranteed to pay out. and you're guaranteed pretty much to make money based on the payout. I just can't tell you when. So that's an opportunity I'm going to have for only the people that are at the 3-day. So now do you want to be there? So with that being said, Stephen, let's hit some questions.
Yeah, there's tons of opportunities on Sunday, so it's gonna be a lot of fun. Can you
Q&As.
dump a lump sum for a toddler's policy? Not usually, because we can't put term on it, on a juvenile policy, but we might be able to get a little bit on there. Usually we can get a little bit in there, just not a lot. Mark said, can I get rid of intelligently my Roth IRA and roll into a properly engineered whole life?
I probably wouldn't want you to do that, Mark. I just want to show you how to be the bank using your Roth IRA.
Right.
So I wouldn't want you to get rid of, I mean, it'd be simple, Mark, to get rid of your Roth because there's no tax consequence.
Well,
You already paid the tax on it, but why get rid of it?
There could be a 10% penalty. Although on the
First 5 years.
yeah.
Marilyn said 18%, how much to invest? The minimum will be 50. I wouldn't be surprised, Marilyn, though, if one person takes the whole thing when you hear what it is. I really wouldn't be surprised. There'll be somebody on the 3-day that's just like, I just want the whole thing. And it's going to be, it's definitely going to be first come, first serve. There's no other way for me to do it. There's no other fair way to do it. I mean, it's really that good of an opportunity.
Only we had an investor club to put that in.
Yeah, I wish we did. That'll be coming in Private Money Club, the investor club. I'm not going to give you any details, Drew. Come to the 3-day. I know you already bought your ticket. You'll be there. What is this? People are like, tell me, what is it? No, I'm not going to tell you. It's 18% interest, fully collateralized, very short term. Oh, I forgot one thing. You're guaranteed in the contract 2 months worth of interest, even if it pays out in a week. You're guaranteed 2 months. I had to add that in because when I was talking to the person, I'm like, dude, like this could end next week based on what you just told me. And the people could get their money back. Why would they go through the effort? And I said, you got to give them some type of a guarantee. And he said 1 month. I said, how about 2? And he went for it. It'll make total sense. And here's the thing about it. There's not one person that will not understand it. There's nothing to understand. It's the simplest thing in the world. It's so simple. So it literally might take me, if I stretch it out and draw it out and try to make it all like sorts of drama in there, it might take me 10 minutes to explain it. But I'm not going to do it until the end of day 1. And then I'll probably announce it again on Friday with the other opportunities. Latia said, how soon can I borrow from my specially designed whole life? Immediately in the first 30 days. Essentially when your check clears. But we always say immediately in the first 30 days. What else we got, Stephen?
Just over in the Q&A, when you repay a policy loan, how do you prevent it from mecking? Is it because the ceiling is built in?
That's a really good question. So basically, I'm going to go over to the drawing. So what they're saying, who is it, Michelle? So what Michelle's saying is, how do we take all this money from these debts and put it back into the policy without macking it? Well, because if we take $20,000 out and we pay $20,000 worth of debt off, we can put $20,000 back in. We can't put $20,000 plus all the interest. So some of this interest you earn is going to sit in a bank account. But for the most part, we can put 20 grand back in. So the name of the game is there's really, once you start using this, Michelle, once you start understanding how this works, it's always going to be money's going in and money's going out because there's always going to be new opportunities and places for money to work. So typically, if you took a loan for 20 grand and you were repaying $1,050 a month from recaptures, eventually that $1,050 plus the new savings you're putting in is going to build up and you're going to have another opportunity. You're going to take money out again. So all you do is you just keep the money flowing round and round we go. Think of it like Monopoly. You know, when you play Monopoly, what is one of the most important things in Monopoly? You gotta go past go, right? You gotta cross go because you get $200. So how many times you want to go around the board? As many as you can. Well, same thing here with infinite banking. How many times you want to go around the circle? As many times as you can. So you don't want to just take money out once and pay off all your debts and have the money coming back and stop. You're going to constantly go around because every year you do get, you know, it's not pass and go, but you get a dividend every year. So every single year you're going to have more money plus the compounding interest. It just gets to be a game of how many times can I go around the circle.
Okay, so I've been working with John Azraf. He's like, I've joined one of his coaching programs, and what he does when he does his trainings is he'll promote like 2 to 3 people, and he'll work with them kind of one-on-one on the screen, and so everybody gets to learn. So I mean, we're just kind of do a little bit of the ending on Sunday, and ask a couple people if they want to be promoted. Like you just pulled me out of the chat and put me up here to speak right now, and finish with somebody who's like, okay, well, maybe I love Greg's thing on Friday, and then this other opportunity you shared with me on Sunday. Like, how can I string that all together so that, you know, people can learn in real time through somebody who's kind of being promoted, giving their thoughts, you know, explaining maybe what they have, the challenges that they have, and sort of making it all make sense, like live for some, like, depending on the time, you know, maybe it'd be like about 10 minutes a person, and hopefully we'll get through 2 or 3 people, but that's how we're going to end the 3-day.
Wow. All right. I saw that in there, but I didn't quite know what that was or where that came from. I want to hit Simon's question real quick. He says, let's say I get a $400,000 life insurance. How much of that can I borrow to buy a house? So Simon, you got to look at this different, because you're looking at it like I think you're looking at it like regular life insurance, like you're buying a death benefit. Here, you're not, you're getting a death benefit, but you're first starting with how much do you want the ability to deposit? So let me just spin your question. Let's say you had 400K and you put 400,000 as a dumping into the policy. You know, then you're saying, how much can I borrow? You'd probably be able to borrow 80 to 90% of that 400,000 to buy a house. So, but you're thinking if you just buy a $400,000 death benefit, how much can I borrow? Wrong way to look at it, because that's not how we design them. It always starts with the deposits. We back into the death benefit by putting the lowest death benefit, which reduces the commission 60 to 90%. So you're not paying big commissions, you're not paying big fees on the death benefit, but you're getting the maximum amount of cash value to use and to grow. So just a different way of looking at it, Simon. We have a great video. You can go to chrisnaugle.com and watch that video, or just join us for the 3-day. We'll dive deep into it. Give Cash the cat a scratch. All right, Mark. Hey, kitty. He loves scratches. Are Trump memorabilia TRBs a scam? Whoever is behind it implies that each $300 item cashed out at BOA within 3 months. Let's just read that again. Okay. I don't mean to be that guy, but Russ, seriously, just read that. Is that a scam? Of course that's a scam. Like, of course it is. Like, if it doesn't logically make sense, like, what else could it be? Like, that doesn't make any sense at all. $300 and then 150,000. Come on, man. That's like, you know, when you're on TikTok and somebody sends you a message saying it's Chris Naugle asking you, you know, hey, you know, I'm going to give you free Bitcoin. Just put, you know, $100 in this account, or whatever the hell they do. Of course it's a scam. I don't even talk about Bitcoin. Hardly ever. But yet, every once in a while, we'll get a call. Hey, you ripped me off, you know, on TikTok. I put money into this Bitcoin thing. Oh, hold on a second. That isn't me. That's not me. That's some scam artist, like, faking to be me, which happens every single day. Yeah. Sometimes you got to use some common sense. I'm sorry. Yeah. Let's see. Through my courier company. Oh, okay. Sorry, I was mixing the two. I got a policy bought 3 years age, 110 a month on 450,000. So yeah, Simon, you got probably a corporate policy. So employer sponsored life insurance, but you're just buying a death benefit on those. Those policies will probably never work for the infinite banking concept, but they're great life insurance through your courier company. Yeah, so we'd have to review that. All right. Well, with that being said, folks, I hope you guys enjoyed that. I hope to see a whole bunch of you at the 3-day Money School Essentials training starting Friday. I right there put the link. If any of you want to see this again, or it won't be exact, but you want to join us tonight at 6 to 7:30, we've got a preview we're going to be doing. And it's going to be some of the same stuff, but a little bit different. And we'll be doing that tonight. That's just for the folks who couldn't make the wealth webinar. We don't do that very often, but we are doing it tonight. So if any of you know somebody who wasn't able to make it to this wealth webinar that you think would benefit from a similar presentation, have them join us tonight at 6 o'clock, and we'll be going through that and making the same offer. All right, John and Stephen, thanks for everything. Irrevocable life trust. No, that would be an attorney. So we have good attorneys. And on the 3-day, we got a really, really good company that definitely does irrevocable life trusts, or ILITs as they would call them. So we can kind of get into that on the Saturday of the 3-day Money School Essentials. Thanks everybody for joining us, and we will see you tonight or possibly Friday. Actually, not possibly. Remember, Cash is going to be attacking you if you don't buy the ticket. So I'm assuming you all bought tickets. See you then. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.